Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Really looking forward to being able to help you with your financial retirement today. Hopefully, we can, find some questions that you want to have answered that we can answer for you. You can send in questions now. This is a live show. We'd be happy to try to answer those live. See if you can stump Eason and I. Have some fun with this. It's always an interesting experience doing a live show. Obviously you can ask questions. We can send those in to asktom@talkmoneywithtom.com, and we'll be able to, answer those. You can send those during the week. You can also put them into the chat here on YouTube, and we can try to answer those live. And then we obviously answer questions that have come up during our client sessions during the week here too. So a lot of these things will hopefully help you, get farther down the road with your retirement. We feel like the more that you know in the area of asset management, retirement planning, and tax management, the better your retirement's going to be. Whether you're already retired or looking forward to retirement, most of these subjects apply to both groups, right? And this is something we've been doing for a really long time, and we're hopeful to help you. We feel like the education in this arena is lacking. That's why we started this channel. So you can feel free to subscribe to the channel if you'd like. You hit the subscribe button. There's a little bell button next to that. You get notified when we put out new content and such also, so that would be great. And then, of course, if you have some personal questions and you'd just like to talk to Eason and I, you can go to our website. There's a book appointment button right up in the corner. It looks just like this, that little yellow button, and you pick a 30-minute, phone or video time to meet with Eason and I, and we can answer some of your specific questions also. So feel free to do that also. I really hope that you get something out of today that you can kind of grab onto, apply to your retirement dream, again, whether you're retired or not, and be able to kind of move forward with that, because this is an important time of life. It can be really fantastic if it's handled correctly, especially the financial part. There's other parts of retirement, obviously. We cover one segment of it, but still an important piece. Okay, so that's what we have so far. I do like to start off each week with a summary of what we saw happening in the stock market. And so the first chart I have here is more of kind of a long-term chart. It's going back to the very high point. That's actually the all-time high ever for the S&P 500 was January 4th of last year. And obviously the market came down, all last year. We're starting out a lot better this year, though. And so that red line kind of is a trend line, very important in the area of what we're looking at when we look at charts. And we kept hitting it and coming down and down and down. We broke that, 3 weeks ago. So that's fantastic. First time. That's a big check mark. The blue wavy line there is the 200-day moving average. So every point on that line is the average of the 200 prior days. We finally broke through that and have held above that for more than just a couple days. We were up for before and then kind of fell back down. So that's a big one. That gold line there is actually the 50-day moving average. And you can see there where the gold line crosses through the blue line, the 50-day crosses above the 200-day. That's what's called the golden cross. That happened last week. Mm-hmm. And that's got a decent track record for reversal of trend, in this case to the upside, especially coming out of the bigger downturns. When we go back and look at, 2020, 2018, 2008, 2000, all of them, when the 50 got above the 200, that was a signal that things were finally changing, because what we're really looking for here is we just want to see the primary direction go from down, which is where we are now, to up. And so these are all part of that checklist. And then last week, we actually checked off another box, which is where you establish a new higher high. All of those peaks are lower, and that's why that trend line is down. And so last week, we had that first time we got above that, above 4,100. Unfortunately, this week, we fell below that 4,100. That's not completely unusual. That happens. But again, we would like to see that happen, get back above that to say, hey, we really are moving in the positive direction. And then I think ultimately, probably the last checkbox that I have, I'd like to see it get above 4,300, because that's the big peak that we had back last summer. If we got above that, I think you've really kind of checked off everything I can think of to change direction, right? So really, really nice.
Yeah, you need some consolidation for in every uptrend because otherwise you just get stretched too thin.
Yeah, and that's exactly what happened. I have an overall market kind of stretch model that goes from +5 when it's really low to -5 when it's really stretched out, and it got to -4, this week and last week. So there was bound to be some pullback. The problem is when you get pullbacks, you look at it and say, "Oh boy, is that just a small pullback because it's stretched, or are we now going back down, to some newer low?" And boy, that is the huge debate right now. Read the articles. Everybody's debating this. One side thinks this is going to go. Another side thinks, oh, this is just a fake move, and we're going to go back down to a new low and go below where we were back. And that little spike down there to that 50% retracement line was October 13th. So that's the big debate. We'll have to see how this plays out. But if you look at this week, pretty wild week actually. And so just to emphasize how important the Federal Reserve is to the market right now, sometimes it's not so much, but right now, because of the high inflation and the possibility of recession, this is all about the Federal Reserve, unfortunately, because it's hard to tell what they're going to do, and sometimes I'm not sure they know exactly either. But we've got this situation. Look at this huge spike that we had on Tuesday, way up, and then way down, way back up. That was during the question and answer session for the Chairman Powell, Chairman of the Federal Reserve. He was doing a question and answer at the Washington, D.C. Economic Club, and just responding to different things that he said. Now, overall, the market was up like 1.3% that day. So the last two times Chairman Powell spoke, because he spoke the week before, when they were talking about the rate increase, market was up then too.
Yep.
And so what's happening is Chairman Powell comes out, he's kind of moderating, he's saying the things that I really am seeing myself personally in the fact, and we'll talk about some of those, but what's happening with the job market and those types of things. Unfortunately, after that, Wednesday, Thursday, we had all kinds of interviews with Federal Reserve governors, and they were much more aggressive and much more, hey, rates are going to go up but they're going to go up higher than people expect for longer than they expect. And boy, there's nothing that you can really do to scare the market more than those kind of words. And I do think that was the objective. They want to see the stock market not take off. And January was hot, really hot. And if it keeps going, I mean, if you look at the NASDAQ, I think January was up, 10 to 15%. So I can't remember exactly. You do that every month, you're going to have a higher inflationary environment because people are going to feel rich, and they want you to feel not so rich. And so there is a reason why the Federal Reserve is kind of pushing on this, and we've talked about this before. And so that, of course, we've seen the market come back down and unfortunately even fall below this 4,100 level this week. And so let's kind of talk about, what's going on there and what's happening altogether. First of all, when yields go up, and so the 2-year Treasury is paying, let's say, 4.5% now.
Yep.
When it goes up, stocks go down, bonds go down, real estate go down altogether. Maybe not on a daily basis or whatever, but you can see altogether that trend was definitely strong. What went down? Real estate, stocks, and bonds. But we had I drew a little blue line in there. We had a nice downtrend going because we were getting good results from the inflation reports. And then, boom, we actually came almost all the way back up to the high point that we established last year back in October because of the report from the jobs report that came out last Friday, which we talked about some. And so we created way more jobs than expected, and people are kind of freaking out that that's going to create inflation. And I'll give you my opinion on that in a minute, but kind of the second piece of evidence of that is what the futures market kind of, I'll say, bets on where the Federal Reserve is going to end up at their peak at different periods of time. So this is July of this year, and we actually hit a new high there. We're at 5.16%. If you do the math, what that means is essentially 2 more quarter point rate increases, one in March and one in May. The May one's new, and that only started to become, a bet that would happen after the jobs report came out last week. And so now there's a higher bet that we will have 2 increases more, and then it'll pause. And so that's basically what it's saying there. And so the market's responding to that and readjusting and coming back down. The higher rates go, the more problem it is for stocks, partly because you can make 4.5% on a 2-year treasury, for example. That's not bad. Not as good as the market has made on average.
Yep.
But there's not much risk in that 2-year treasury. If you hold it for the 2 years, you got the U.S. government standing behind it. And so that becomes this competitive asset, for that. And so less money will go into stocks because more money is going into savings and CDs and treasury bonds and those types of things, right? So that's one of the mechanisms that, and there's others, but that's one of the mechanisms that kind of drives the market down. Now, my overall thought process here is, I remember times when the Fed funds rate was at 6%, which is higher than this.
Yep.
We had fantastic markets. I mean, so I think it's partly an adjustment to this and how fast rates have come up. Once things do settle down, the market can still run here because even though it is competitive, it's not as good as the new AI stocks or whatever it is that people are into, at any point in time. And so really, really fascinating what's happening with the rate market.
Yeah, and you could see the market kind of followed as the rates went down, the market went up as a whole, as a kind of an overall trend.
Yeah, and that's why, just flipping back to the 2-year treasury, that's why I follow this so closely. It's exactly right. This is sort of a barometer for where the markets are going to go, in my opinion. So, all right, so moving on to kind of this jobs report and why I see this jobs report as positive, even though the market seems to be seeing it as negative. And I think the key differential is that, at least from the interviews from the Fed governors, from the articles that I've read, they're looking at the 1970s. And in the 1970s, we had high inflation. And in order to bring down inflation, we had to basically kill jobs. I mean, millions of jobs would have to disappear to do what they were trying to do because they're trying to kill demand, right? So, but this is a pandemic-related inflation scenario. And this is why when Chairman Powell speaks, the market goes up because he starts talking about, hey, this is a different environment. This isn't the same environment as we had in the past because this is a pandemic environment. And so what this does is show inflation, over time. Green line is overall. See the big dip in 2020, still going up. It's always been going up. It's a matter of how much. They want to have it go up at like 2%, and it's been going up at a faster rate than that. But my key point here is that if you look at the services, which is the yellow line, it's still going up. But the blue line, which is goods, really didn't have a big dip for starters, and it's starting down now.
Yeah, it's not really. It's kind of flatlining.
Yeah, because, again, what could we do during the pandemic when we were stuck in our homes? We could order stuff, but we couldn't go to the restaurant. We couldn't get on the airplane. We couldn't, they weren't even flying for a while, right? And so what are we doing now? We got this pent-up demand. It's like, well, I don't want to buy a big screen TV. I want to go to Hawaii, that kind of thing. And so the money being spent on services has been tremendous, and there's a lot of pent-up demand, and people are really getting out there and going, right? So in my opinion, if that's the high inflationary arena is services, you need more labor, because one of our problems is just that the labor force participation is still down from where it is. So, but prior to the pandemic, it was much higher. This is probably 2 to 4 million more people working than there are now. It's amazing that we don't have more, inflation, and because we have all of these job openings, and that's here too, that are kind of driving, this need for people to come back, especially in the service arena. And here they are coming back. The trend is good. Matter of fact, that job report had the highest labor force participation rate, or tied for the highest, for the year, which is good. That we need to see that. And that's what makes this different than the 70s. In the 70s, they had high participation rate. It wasn't a shortage of supply. It was too much demand. And they had a whole energy problem, too, with, the whole thing that happened there. But nonetheless, this can be solved by getting more people back to work. So when you get, and this is from last week, but when you get 517,000 new jobs in 1 month, which is what happened in January, that's a good thing. People are coming back to work. Because again, if you have a shortage of labor in your business and an oversupply of demand, I mean, look at the airlines. So if there's 3 people trying to buy that ticket for every single ticket out there, they can charge more, and they did. Boy, airline prices went up a lot. If they get more pilots, if they get more people back in, and all of a sudden there's only one person for every ticket, then the inflationary pressure on that starts to fall off. So we need to get people back to work, and this is part of that, right?
Yeah, and there's some speculation that February and March will also be weaker because of January was so strong.
Oh yeah, matter of fact, they readjust these, so we'll actually find out what January's number was in, next month, because they might up or down this, and I wouldn't be surprised. It was a really surprising number. It was the biggest. It was supposed to be 188,000 jobs, right? So as far as since the pandemic, to me, that's the biggest surprise to the upside. And that's why the market is really, oh my gosh, we're going to have to raise rates way higher and all those types of things as far as that goes. But this is an important point. The Federal Reserve governors are coming out and they're driving and talking about higher interest rates. And the bets that are going on behind the scenes in the futures market are starting to really go towards 6%, right? Altogether. And the problem is that people are seeing this data and they're seeing, hey, we could have lower inflation just because people are finally starting to come back to work. I think personally one of the reasons that people come back to work is twofold. Number one, there's a little less fear of the pandemic itself, the virus. Number two, they need to, because things are costing more. That inflationary pressure is kind of getting, there was lots of early retirements. Some of those people come back. There's lots of, apparently, 18 to 34-year-olds sitting at home on their couch. They might come back. Men, in this case. So who knows what they're doing. But nonetheless, I find that a very fascinating stat. I'm not sure why that is. I've been very interested in labor force participation has been dropping really since the 90s, which I find very interesting. But nonetheless, so that's what's going on here. Again, I see that as a positive for the market, not a negative like the market seems to see, because I see this as a different situation. If you listen very closely to Chairman Powell and not so much to the other Fed governors, I think he's saying the same thing. And he seems very pleased with what's happening altogether because he's seeing some disinflation, right? Lower inflation on goods. He's worried about inflation on services. This is one of the ways that you help inflation on services is you get more people back into those jobs, right? So I think that's good. Now, if you can do that and also have lower wages, right? Because in the 70s, one of the things that happened, they got this wage spiral, they call it, where, the number of people coming into work, wasn't enough. And so they're raising rates and rates. So we're seeing, and this is from Friday, we're seeing the average hourly earnings rate on average year over year come down. This is a perfect situation. We had created lots of jobs and we did so with lower wage rate increases. So I think that's very, helpful in this inflation fight, especially in the service category. So we'll see how that plays out. Okay, so there is one other thing that's happening that's very important. I'll finish up with this. Next week, on Valentine's Day, of all things, they are going to be reporting on Tuesday the CPI report. So that's the Consumer Price Index. There's 2 different ways that we look at this. How much inflation on that basket of goods, and I'm using core inflation here, not the overall CPI number. A lot of people know that one, but the Federal Reserve looks at core because core does not include food and energy. The Federal Reserve considers those out of their realm.
Yeah, outside of their control.
Yeah, and probably even some of these core things are outside their control, to be honest. They don't have as much control as we'd like to think. But nonetheless, they focus on core, and when they're trying to get things down to 2%, they're talking about core inflation. So in this case, CPI was at 5.69 for the last report, right? So we're going to be getting January's CPI. Well, there is a projection out there from the Cleveland Federal Reserve. They have a thing called Nowcast. So they're predicting for January 5.58, right?
Yeah.
That's not a big difference, 5.69, 5.58. But down, still continuing the trend. We'll see what actually happens. This is a projection. They actually tend to be a little bit high on average, if you look back. But nonetheless. But there is one concerning aspect, and that's the month-over-month inflation. So Here's month over month inflation. So in this case, we're looking at this January versus December of last year. And if you look at month over month, I'd say overall that's coming down, but most recently it's actually coming up.
Yeah, slight tick up.
Yeah, and so one of the problems is if you multiply that times 12, you get pretty high inflation, right? And so 0.3, not too bad. That's 3.6%. Okay, that's awesome. But the projection is actually at 0.46%. So now you're getting back towards more of a 6% range of inflation, if I round off to 0.5 here. And so that is kind of continuing that month over month trend to the upside. Again, they do tend to project a little bit high here, but I also think this is one of the things that the market is looking at and thinking, oh, okay, maybe we need to back up a little bit, get more conservative. This is what we're going to do. We've got a lot of pieces in play, and really what I'm talking about moving are the target pieces that we have inside of our IRA type of accounts and Roth accounts and those types of things. So there's no taxes or anything. And so we'll probably rotate those target pieces. The things that are doing quite well right now in this downturn are the high dividend paying stocks, those ETFs, the utility stocks, and energy is actually making a run too. The energy can have its own path. It does all kinds of things actually. I think energy is probably running because of the reopening in China.
Yeah.
They're one of the biggest, users of energy. As they get going and their factories really get going, there could be more energy consumption there, and of course that drives things as far as that goes. So, those are areas we'll probably move those targets into and leave alone the other aspects of what we're doing. Just get a bit more defensive, still staying in the market, but in responding to what's happening here. And just let's wait and see what goes on. Again, the fear altogether is that the Federal Reserve will actually do what these Fed governors are talking about, and they'll raise rates to the point where we end up in a steep recession. I mean, one of the Fed governors was talking about, hey, it's okay, it's better to overraise rates because we can fight inflation, fair enough. But he says, we can always, lower them again if things get bad. Well, unfortunately, in that gap between when you stop raising rates and lower, we're going to have a 20% drop.
Yeah, it's a lot of hurt.
And the job losses and millions of people losing their job. I thought it was a really weird comment. I understand what they're saying, but boy, if that's your thought process, that's a little scary, and that scares the market. The Federal Reserve has overraised rates many times. They caused the 2008 downturn, in my opinion, the 2000 downturn. They did 19 rate increases before 2000 and 21 rate increases before 2008. We can look back now and say those were too many rate increases. And so the fear is that they're going to do it again. Now, Chairman Powell seems to have pretty good powers. One of the questions that came up, do you get to decide on what the rate is, or is it the Fed governors or other people that are there? It was a little bit of a confusing answer, but my overall opinion was that he has an awful lot to say on what's going to be the ultimate rate increases and where they're going to end up. He seems the happiest. He seems the most centered around all the things that I think are important to be looking at. It's why the market keeps going up when he speaks. So that's going to be an interesting battle to see how that plays out here over this first half of the year. So anyway, very, very, very interesting time to be looking at what's going on with the market and to kind of understand, boy, this environment that we've been going through here since 2020 has been very educational. If you watched, we started our videos in 2020. If you watched those and you saw what's been happening, there's a lot to learn here. It's really interesting. So anyway, that's our overall outlook on the market. A little bit longer than usual, but this is just a really incredible time right now. So let's answer some of the questions.
How do you balance diversification versus home run investments? I want to invest into AI trend, but I'm struggling between choosing individual stocks or the ETFs.
Yeah, okay. That's a good question, actually, because we get that a lot. You want to be, in my opinion, pretty well diversified because you want to be able to kind of handle all of these things. Really what you're saying when you're diversifying is you're not positive where things are going to go, which should be true. Not many people, have demonstrated that ability to know where things are going to go. So if you kind of own everything or lots of things, then if it goes there, you own it, right? And so let me share my screen because I do have a. We'll use this shot here. There we go. This is the basic model we use.
Yep.
Okay, so there's 3 big core pieces, right? And those big core pieces are wildly diversified. We will use things like the Vanguard Total Stock Market Index, ETF, which is VTI. That owns almost every single stock in the U.S. We will use maybe the ESG version of that because it does well, or we'll use the S&P 500, or even VT, which is the Vanguard Total World Index. I think it's over 7,000 stocks now. Those are the types of things that I consider core holdings, massively diversified, right? And if you look at that, at least from this is our 100% equity portfolio, roughly 3/4 is in that diversified segment. The rest are in what we call these targets. So for right now, we have 4 targets, 6% each, right? We're using ETFs as far as that goes, but those are the ones that we will rotate more often. I don't really go out into the AI arena because it's too crazy. We're seeing some movement in semiconductors, and we do have some of that right now with the SOXX, the Semiconductor Index ETF. Although we may rotate out of that here temporarily to get more defensive, but nonetheless, that's exactly what we're doing there, is just trying to go with the flow to a certain degree with those. But this is our base model.
Yeah, so let's say I want to get into AI. Would you maybe split it? So one of the targets would be the AI target, and maybe I do half of it into an ETF, and then the other half I do individual stocks. So maybe I pick 3 stocks for 1% each.
Yes, that would be perfect. From a retail investor standpoint, that works, right? For your own account, for us, when we're managing these big accounts, we have 800, 900, 1,000 accounts. I've lost track, right? And so we have all different sizes. And so one of the problems we have with that scenario is just if I have a 1% slice, which you could do on your own, I might not be able to get everybody into that because they don't have enough money in that particular account to buy 1 share. So, but yes, exactly. So you can slice and dice, those targets as far as that goes. Especially knowing that, hey, I've got a great diversification in the rest of the portfolio, and I'm just trying to kind of go after a few different areas that I think are interesting that might outperform the market in those targets. And in this case, it's limited to 24% of the portfolio, right?
Yeah, and for a home run investment, you don't need to make a big investment to have it return quite well.
Yeah, exactly. I mean, I've got some great stories with, mid 90s, 14,000 into Apple that's worth, 2.5, 3 million now. Different things that we've seen within the practice that clients have done. If you have a true home run, and they're rare, and most likely going to have way more strikeouts, but once you get one and you let it run, it doesn't take a lot of dollars.
Yeah.
Yeah, I mean, 1% into something that is exactly right. We had a client buy a small amount of Tesla, and even though it came down a lot, and although it's had a heck of a run this year, that's been a nice piece, right? That's worked out really well, but it was started off with a pretty small dollar amount. If it disappeared, it would be like, okay, it's the way it works. So, yeah, I think that's important. I do meet with some people, especially younger people, especially during the 2020, run up, where they were doing the entire portfolio was in the craziest things I've ever heard of. And, a lot of them are no longer actually doing investing because it's so hard. It's just like in baseball, right? I don't know the exact stats, but the biggest home run hitters tend to be some of the higher strikeout guys too, right? And so, again, that's okay on small portions of your portfolio, but do you want to strike out over and over again on your entire portfolio? It depends on your age, maybe, and your outlook. But again, that's just a personal opinion. It's just kind of how we manage money, a little bit more conservatively as far as that goes. So that's a good question.
What happens if my retirement assets are too conservative?
Oh, well, that's just kind of the opposite of what we just talked about. So, good question. Too conservative, and that's boy. I tell you what, that word itself is, just it's a personal opinion. Let's just face it. I mean, I met clients, that what they say is conservative is still very aggressive, or vice versa. Yeah. But let's just take kind of a hypothetical example, and we have a chart for this too. This is the advantage of sending us these questions earlier. We can create some charts. So let's just say we've got an example here. We have a situation where the client, let's say, currently has like a 60-40 mixture. We are looking at all of their parameters that we can push into this plan. We're looking at, what they want to spend, and, how much in travel, and what assets they have, and upcoming events, taxes, all these things. Once we have that all into the financial plan, or the retirement plan in this case, we're going to push this Monte Carlo simulation button and see, does it work? And so, for example, here we go, and we're going to push the button. That's kind of cool. And boom, there we go. 96% probability of success. This is a 60% stock exposure.
Yep.
Right? And so it works, right? And again, one of our litmus things is above 85%. We like to see a lot, right? And, sometimes people fall below it temporarily or what have you, but for the most part, we try to keep people above 85%. And so this is great, but we can also go in, and the way to answer this question is to take that plan and go in and change the projected portfolio to say something like 20% stock or 10% stock. Does it still work?
Yep.
Well, here's the thing. Sometimes it still works no matter what you use. Whether you use 10 or 100% stock, it still works. Why?
Essentially means you have enough assets that you really could be out of the market completely.
Yeah, exactly. So somebody who has an abundance of assets compared to what they're trying to do with those assets in terms of what they're trying to spend, it works. So yes, you can sometimes be way more conservative and still have it work. But sometimes you can be too conservative and it won't work. So if we give an example here of another the same situation where we change it from 60% stock down to 20 and we test it, because this is how we would answer this question in a live appointment, right? We go back in, we hit the button again, and what happens? Bummer.
Yeah.
48%. So in that case, with this person, with this assets and these spending, it doesn't work to get more conservative. You will actually have a much higher chance of running out of money because essentially you just don't have enough to keep up with inflation, is more or less what it comes down to.
Yeah, and this is really shown on a longer time horizon.
Yes.
Say if you're in a 5-10 year window,
Right.
probably you could get away with a more conservative portfolio. But
Yep.
when you're trying to do it for a lifetime, it really can make a difference.
Oh, that's a great point, because we sometimes get quite conservative. We've had situations during this downturn where we've taken a 60% portfolio down to 20% or less stock, but it's temporary. We're not expecting to stay there, and we've already gotten back to full 60% for that portfolio. Yeah, so it's not so much a temporary thing. It's more of a, hey, here's your lifetime allocation goal. What works? And so to answer this question, if you really want to answer this question, you need to have this type of tool where you can put in all the parameters and see what happens and where does this go and how does this work out. I think this is my favorite part of this portion, is trying to answer those questions with these very powerful tools.
Yeah, it's essentially impossible without knowing your specific situation, or
Yeah.
we could never give you a determinate answer.
It's one of the disadvantages of doing a live show and having question and answer coming in, because literally we'd have to interview you for 45 to an hour in order to figure out what the two parameters, and that's why we're trying to encompass. We're not trying to dodge the answer, but the answer is yes, you could be more conservative and it won't affect anything, or no, you can't be. And the way to answer that is by putting all that in there and running this Monte Carlo simulation and see how that works. And so it's a great question. It comes up. It's really important. I've heard so many people tell me, oh, when I get to retirement, I have to get more conservative. Well, it depends. It depends. We have to look at that. And my overall view has been that not many people actually do that. They whatever they kind of had, they're used to. They kind of run with that. Maybe eventually, I don't know. It's not about retirement or not retirement. It's about your personality and your ability to handle risk, in my opinion. All right, good. What's our next question?
Is there any validity to the Super Bowl indicator?
Super Bowl indicator. All right, so fill us in on what the Super Bowl indicator is.
So the Super Bowl indicator is basically if the AFC wins, which is basically a conference in the NFL, the stock market will go down, and if the NFC, the National Football Conference, wins, they'll go up. And so based on whoever wins, which team wins the Super Bowl, it predicts where the market will go.
All right, well, this is kind of topical, right? Because Sunday is the Super Bowl, and depending on the answer to this, it might depend on who you want to vote for based on your wealth. Do you want to be wealthier or poorer? Does this indicator actually work? Well, we do have, of course, a slide for that. And so this is what the last 10 years or so of results. What happened? Who won? Which conference were they in?
Yep.
And was it right or wrong? Well, for the last 10 years, one, two...
You got 4 right.
4 rights. That's terrible.
Yeah.
So vote for who you want for.
Yeah. I don't think the Super Bowl indicator works anymore. Before 98, it was 90% accurate.
Wow.
And then in the last 56 years of the Super Bowl, I think it is 41 out of 56 times right. So
Okay.
it's gone down quite a bit, though, from its heyday.
Yeah, that's interesting, isn't it? So you don't have to vote for the Eagles if
Yeah.
you don't want to. You can actually vote for the Chiefs, at least historically here on this short-term 10-year run. It has. I mean, look at last year. So the NFC won. The Rams, but the market dropped 19.44%. Which is that the worst in this 10-year period? Yeah, it
Yep.
is. The last time it went down, the NFC won also 2018. There
It was also the
down
Eagles.
6. It was also the Eagles. So yeah. So anyway, which makes sense to me, right? I mean, there shouldn't be a strong correlation. I mean, what difference does it make which team wins as far as that goes? I don't know. Maybe if Washington was in there, there'd be some correlation. The senators and Congress people might get excited about that or something. Who knows?
Yeah, this is more like someone's trying to make a correlation out of something that doesn't really have any kind of linking aspects together.
What's that saying? Is correlation causation? I forgot. When I was working with the high school kids on the golf team, correlation without doesn't particularly mean causation.
Yep.
Something like that. Anyway. So anyway, statistically, long term, it has been accurate. NFC wins, market goes up. The last 10 years, it's been pretty awful. Less than average. In terms of being accurate. So, but it's a good question. It's very topical. Something coming up here could be a good game.
Yeah.
Yeah, I mean it's a good matchup between two good teams. I'm kind of excited about it. We'll see how it plays out. All right. Next question.
Should I be looking to make my financial decisions or actions on perfect timing or just good enough? Like the market's just good enough, I should now act.
Yeah. It's kind of like paralysis by analysis, right? In a way, right? I mean, is it good enough or is it the perfect time? I would say if you get the perfect time, you probably got lucky. And because that happens all the time for me, I'll decide, as we've been working our way back in here to the market, the big core pieces that we have, we put one big chunk in and the market dropped, and it was like, oh, brother, but now it's above that. So it wasn't perfect timing, that's for sure. But it was good enough, at least for the moment. The market's above and that position is up. Once in a while, and I make a lot of decisions on the market, for example, and there's lots of different decisions people might be making. Once in a great while, there'll be perfect timing, and that's really fun. It makes you feel like you're really smart, but most of the times you have to be careful with that. If you're waiting for perfect timing, you might not even get just good enough.
You might miss out completely.
Yeah.
And that's the bigger issue is that you don't want to make a decision and totally miss out on that decision because you can't find that perfect entry point.
Yeah, long term especially, things kind of work out. The market goes up, house prices generally go up, right? I've heard many people, I remember the 2008 housing downturn. Oh, then my house will never be worth that much again. Well, what it did. I remember the 2008 downturn with meeting with clients. So my accounts will never be up that high again. Like the 2000 downturn, for example. It did. I remember in 2000, the NASDAQ went nuts in 2000. That was crazy. And it did take a while for it to come back. But guess what? It's higher, even now, after this downturn. So, if you look at long enough term at high quality assets like homes and real estate, stocks and bonds that are, that you gotta be a little careful there because you can get the wrong one that doesn't come back, right? I mean, whether it's a house in the wrong area that literally falls apart, or more likely a stock. I'm talking more about the broad market.
Yeah.
And the broad markets in general, because boy, there's a lot of stocks that are gone, right? In 2000, bingo.com went up 900%. Does anybody know what that is now? No, because they're gone. So you got to be a little careful with that. But if you want to talk about the entire market, good enough, it works.
Yeah, you can. And one analogy you could say is golf, for example. Like, a perfect timing, maybe a hole in one shot, or you hit just perfectly. But you can still be a good a pro player and not hit hole in ones.
Yeah, I think Tiger Woods is a great example. So Tiger Woods only has 3 hole in ones on the PGA Tour, right? 3. Now, he's done pretty well. He didn't have to be perfect with his, with his shot on that many times in order to be. We know who he is. Yeah, he's not bingo.com. So, yeah, he's good enough. Even still, actually. So yeah, that's a great analogy. Actually, that's a good one. All right, we got time for one more question.
What's the difference between active and passive investing?
Active and passive investing. Okay, so actually, let me go back to this shot of kind of our core model and use that as a little bit of an example. So with active investing, it's moving around. Right? Mm-hmm. And passive, it's not moving around, sort of. So, for example, if you looked at the S&P 500 index and you just bought the S&P 500 index and you just held on to that, that would be essentially passive investing, right? And you can buy like we do. We have one of our big holdings is the Vanguard S&P 500 ETF, ticker symbol's VOO, right? That would be considered passive investing there because Vanguard's buying that index. They're not moving it much. I'm buying that index. I move it a little, but not much. I'm trying to buy and hold those things, that type of thing. Now, S&P does change who's on that index. Yep. So there is some motion, They added Tesla. That also meant that somebody had to get knocked off, right? So, but when they're talking about active versus passive, they're basically talking about these big indexes that you would buy. There's not much change.
Yeah.
It's very slight. Now, for us, when we look at our overall model, the core pieces would be more the passive parts. We want to kind of buy and hold those, especially in normal markets. And our target pieces are where we're going to be more active, so we might move those depending on what we see happening as far as that goes. So there's kind of different levels. There's if it's an ETF or fund, it's what they're doing. And if it's an index that the fund is buying, it's what the index people are doing, as to how much motion. But there is a big debate as to what's better. Active costs more, generally speaking. If you go to look at, active mutual fund versus a passive mutual fund, you'll see a differential in the cost internally, right? So, that type of thing. And that's the difference. That's how it works. I really like the passive portions for a big chunk of our portfolio, and we've been very successful with that. We're here today doing this show because of a big chunk of our money has been in passive investing. Has worked quite well. I find it to be very satisfying.
Yeah, I think a hybrid system is usually the best of both worlds.
Yeah.
I don't think in each situation there's going to be always a specific situation where active may do better or passive will do better, but having both is kind of gained that both.
Yeah, and that's essentially what we have, right? Our targets are active, and our core is more passive. Yep. And so yeah, I agree with that too. We're just trying to add a little bit of return to the portfolio to see to justify our fee and what have you too. So good. All right, that is our show for the day. Really, thank you for coming. I'm so pleased that you asked the questions that you asked. Please send in more. We constantly are looking for questions. Give us a chance to be able to answer those. Now, we will not be here next week,
Yep.
right? So we won't be doing a show next Friday. I'll probably still try to do a summary and send that out and post that for the week in terms of what happened with the markets. But send the questions in anyway, and we'll be happy to be able to kind of work on those and try to answer them intelligently as far as that goes. Of course, you can subscribe to our channel if you want to keep learning, find out what we're posting on there. You push the bell button also, and that'll give you some notification as when we're posting something new. So very excited about our channel here. I think that there's a big lack of education in this area of retirement planning and what have you too. So, and then of course you can always set up an appointment with us. You can go to our website, hit the book appointment button, sit down, on a video or phone call with Ethan and I for 30 minutes, and we'd be happy to, help you out and try to see, what questions we might be able to answer with you personally. So thank you very much for coming today. I'm so pleased that you were able to join us today, and look forward to seeing you in 2 weeks, right? And thank you very much.